Hello and welcome to my channel Making Money and Finance. I have a new video for you today. We'll discuss personnel finance, and we'll try to address the question, how do the rich stay rich? Before I begin, I want you to hit the like button, leave a comment, and subscribe to our channel so that you are the first to know when we upload a new video. And if you find our video useful, please share it with your friends and family. We are going to talk about how the rich stay rich, but we are going to address this issue by looking at the expression, buy, borrow, and die. In this video, we are attempting to help you increase your wealth and gain control of your finances. In addition, we are going to discuss how the rich keep rich. How the wealthy maintain their wealth by using loopholes in the American tax code. Professor Ed McCaffrey coined the phrase, buy, borrow and die, more than 20 years ago. He uses this straightforward phrase to sum up the structure of the American tax system. To put it succinctly, the fundamental idea behind this is that wealthy people purchase various assets, such as stocks or real estate, bonds or commodities, and then opt to take out loans secured against these assets rather than selling them. And ultimately, they pass away in the estate, which means that the assets are distributed to their heirs or beneficiaries. In this video, we are going to examine these three phases in further detail in order to learn how the rich maintain their wealth by utilizing the strategies of buy, borrow, and die. The very first step is to acquire some form of property. If you have such assets as stocks or real estate, for instance, let's suppose that you have $300,000 on your investment portfolio. That is money that you may borrow against in your taxable portfolios. This is one method that you can use to maintain your current level of wealth. The same process is more tangible, such as in the real estate market. People who possessed a net worth in the hundreds of millions of dollars frequently put the buy, borrow, and die strategy into practice in their business dealings. These wealthy families would possess apartment buildings and office buildings, and they would simply borrow against these assets, refinance, withdraw the money tax-free, and live off of that money while the building was still cash flowing. Because they never truly sold the property, they were never required to pay any capital gains taxes. You need just treat it as an asset in order to use it as security for a loan. Why is it a good idea to have assets in the form of real estate? Because regardless of what may happen throughout time, its worth will at least remain constant in relation to inflation. In most circumstances, it is not extremely volatile either, and depending on the region, you can typically depreciate against it, which will assist minimize the amount of taxable income you bring in. The most interesting aspect is the fact that the vast majority of banks prefer to both borrow and lend money based on real estate as collateral. If all goes according to plan, the next phase in the process will be to borrow money against these assets. This collateral will get us there. Therefore, the following step is to borrow, which is just what it sounds like. You borrow against the asset that you already possess. Suppose you are in a position where you require immediate cash due to unforeseen events, and you have $300,000 invested in the stock market. It would be ideal if the financial institution from whom you obtained those funds would agree to grant you permission, for instance, to borrow 37% of those funds at an interest rate of 2.5%. So, this is money that is not going to cost you anything and can be used to protect yourself. Because more people are taking advantage of that system, the total amount of borrowing keeps growing at a significant pace year after year. This approach, which the wealthy utilize to maintain their wealth and keep it coming in, is widespread. You ought to do the same. The same strategy will yield the same results in real estate, just as it will elsewhere. Let's imagine that the annual net operating income of a building that you own and which is valued at $1 million. If you want to take out a 70% loan on this property, the people living in that building would be eligible for a tax-free income of $700,000. This is analogous to taking out a loan against the value of your stock portfolio. You could be one of these people who avoid producing a taxable event by selling their stock, but at the same time, they are still able to receive the cash that they require to maintain their standard of living from buying. The wealthiest are getting richer while the poor are staying where they are, while you may avoid a taxable event, and these assets are often growing in value as a result of all the money printing that has occurred over the years. The third step is currently the most crucial one, and it will actually be the last step when you die away. When you pass away, your beneficiaries or heirs will normally get the inheritance of your estate. What will happen is that the loans will be able to be paid off by selling the assets that were used as collateral when the loans were initially taken out. On a cost basis, the heirs receive an increase when they inherit these assets. In the storage unit of the $1 million building that you purchased, say, 20 years ago. It is now worth a total of $2.5 million thanks to its growth. Because the heirs are receiving the property at a cost basis of $2.5 million at the time of your death, you have the option of either borrowing against that building again or selling it for $2.5 million without having to pay the capital gains tax. There is a popular strategy in real estate known as a 1031 exchange, which means that if you sell a property and find a lake and similar property within a specific time frame, you can actually avoid paying the capital gains tax on the initial sale of that property. This strategy is popular because it takes advantage of a technicality that is unique to the real estate industry. Therefore, each and every real estate developer that I am familiar with did this with the intention of dying without ever having to pay those capital gains taxes. Therefore, if we wanted to use stocks as an example or ETFs, let's say that you purchased an ETF with a cost basis of $10 in the past years, and that your investment in the stocks has grown to $1,000 per share by the time you pass away. In this scenario, your estate would be entitled to $1,000 from each share of stock. If your heirs decide to sell that ETF or shares of Apple today at a price of $1,000 a share, they won't have to pay any capital gains tax because they didn't make any profits in the first place. They obtained the stock or ETF at a cost basis of $1,000 for each share they were given. If at that point they decide to pay off the debt, they can use the money that they received from the sale of the ETF or the bonds. Now that you have a better idea of what it means to buy, borrow, and die, you might be wondering why everybody doesn't have a lot of debt and a loan-to-value ratio of 99.9% on every single item that they possess. Even after you have completed a cash-out refinance on a piece of property, you need to be sure that the numbers still add together. For instance, the stocks that you are borrowing against could see a decline, and if this occurs, you would receive margin calls requiring you to make up the difference in order to maintain the 37% ratio on your investment. Therefore, it all boils down to what you feel most comfortable doing and the purposes for which the funds are being used. If you use that money to generate more money, it could be a feasible plan. However, it could also be a double-edged sword, which can be an extremely dangerous way to go about things. Therefore, the majority of people use this for the objectives of estate planning and wealth accumulation. There are taxes imposed by the state, in addition to taxes imposed on wealth. This tactic is a leverage tool with two sides, just like a sword. You can file for bankruptcy, lose your home in a foreclosure, and have your empire crumble overnight. Therefore, exercise extreme caution with regard to leverage, and proceed with caution when utilizing this method. There are a number of people I know who have taken advantage of its full potential, but there are also a lot of people who have been hurt by it. I make sure to put my money into the golden middle every time because it allows me to have peaceful nights of sleep. Therefore, you can add this to the toolkit you already have. If you learned anything from this video, please share it with a friend, press the like button, and subscribe below if you haven't already. Thank you so much for watching. See you on the next video.